Passive income through options trading is a pretty good way to generate income by selling options instead of buying them. When you buy options, it can be a little bit risky because you do need that stock to move, sometimes significantly, in order to make a profit. But when you sell options, you collect premium and you make income even if that stock does not move in your favor. Now, one popular strategy for selling options is a simple covered call. And this involves selling a call option on a stock that you already own. And when you do this, you receive a premium up front. So if that stock remains below the strike price of the option at expiration, the option will expire worthless. You get to keep the premium. Now, the opposite outcome from that is when the stock price rises above the strike price of the call option that you sold. So in this instance, the buyer of the call option, they may exercise their right to buy that stock from you at the strike price. And you get to keep the premium that you received up front, but you will have to sell your shares at the strike price, even if the market is really high. So this means that you might miss out on any gains above the strike price. As an example, let's say you sold a covered call option on a stock that you have with a strike price of $50 and the current price is $45. So if that stock price rises above $50 and that buyer exercises their right to buy your shares, you get to keep the premium, but you have to sell your shares at $50, even if that market price is $55 or higher. And while missing out on the potential gains can obviously be pretty disappointing, it's important to remember that the covered call strategy, it's just designed for generating income and not maximizing capital appreciation. So another strategy is cash secured puts. And this strategy is you sell a put option on a stock that you would like to own. By doing this, you collect a premium and potentially obligate yourself to buy the stock at the strike price if it falls below that level. If the stock price remains above the strike price at expiration, that put option expires worthless. You keep the premium anyway. Now with the cash secured put strategy, the worst case scenario, the stock price falls below the strike price of the put option that you sold. In this case, the buyer of that put option may exercise their right to sell that stock to you at the strike price. And as the seller of that put option, you got to buy the stock at the strike price, even if the market price is lower. So that means that you may end up buying the stock at a higher price than its current market value. So let's say you're interested in buying shares of XYZ company. Right now it's trading at $50, but you believe that that price of $45 a share is a better entry point. Instead of waiting for the price to drop, you just decide to sell a cash secured put option. So you sell one put option contract. Strike price is $45, so it's 100 shares, right? So assume the put option has a premium of $2 per share. Since one option contract is 100 shares, you get $200. As this is a cash secured put, you have to set aside $4,500 in your account. That's the 45 times 100. This cash has to be available in your account to purchase these shares if the option is exercised. So here's some outcomes. Company stays above $45. That put option you sold probably expire worthless since the market price is above the strike price. You keep that premium as your profit, $200. You do not purchase the shares since the option was not exercised. But let's say it falls below 45. That buyer of that put option may exercise their right to sell you the stock at $45 a share. So now you have to buy 100 shares of XYZ at $45. That's your $4,500 that you set aside. It doesn't matter if the stock price is lower. Let's say it's $30. You got to purchase it at the predetermined price of $45 a share. But you get to keep the $200 premium. But now you own the stock, which may be worth less than your purchase price right there and then. But you want the stock anyways. Now, there's also other strategies like protective collars, call credit spreads, put credit spreads, iron condors. There's a bunch of them. Now, each of these strategies has their own risk profile and income generating potential. You got to understand each strategy. You have to assess your risk tolerance and your goals with income before you implement them. Now, we don't just do options. We can do other things for passive income. We can do value investing. That's undervalued stocks, and you can invest in them with the expectation that their value will increase over time. We have dividend investing. That's investing in dividend stock. These are companies that distribute a portion of their profits to shareholders on a regular basis. And maybe leap options, iron condors, even cryptocurrency to generate passive income. Now, leap options are just contracts with options that have longer expiration dates, from 1 year, generally up to 3 years. And that allows you to benefit from price movements in the underlying asset over a more extended period of time without worrying about expiration. Iron condors, just strategies that involve selling both a call spread and a put spread with the same expiration date. But you got to remember, each of these strategies are going to have their own unique characteristics and their own risks. So you got to really research and understand them before you use them. And if you have any questions and you want some further guidance on options trading or some other income generating strategies, you got to reach out to our support staff at support@netpicks.com. Here you can get the necessary information to help you understand and even navigate this world of options trading efficiently. We're really known for our options trading here at NetPicks. So again, feel free to email our support team, support@netpicks.com, for any questions or assistance that you might have. Thanks for watching. Talk to you soon.